Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. Recently, you might have seen an advertisement of new fund offer by Axis Mutual Fund House launching an index fund on capital market theme. Now, the reason I'm showing you this is because if you ask me that Rahul, which is that one theme that I am bullish about for 2040, then I would say capital market theme. Why am I saying that? Three big reasons for this. Allow me 1 minute of time so that you understand data-backed analysis. Now, the first reason is the transactions that are happening in Indian stock market. For example, if you look at since FY16, equity volume has grown at around 23% CAGR basis. And forget about equity volume. Look at the derivative volume, which is FNO. It has grown at around 67% CAGR basis since FY16. And see these tall buildings for FY24, 25. Huge growth in FNO volumes. Now the million-dollar question is, can this trend really continue and sustain? Absolutely possible. Why? Because if you look at the equity as a percentage of household assets, in India it is still very low at around 6% only. Compare this with USA where it is around 22%. So there is still a lot of room for growth coming in terms of the volume of Indian stock market. And the direct beneficiary of growing volume in Indian stock market will be who? Your brokerages, your exchanges, your depositories, your AMC business. In fact, I'm going to show you in this video 3 stocks and I will talk about the impact of transaction volume into the profits of these companies. Extremely important data point that you would not find anywhere. Now, the second important reason that we need to understand is the growth of DEMAT account. If you look at my screen, you will see that in the last 5 to 6 years, the growth of new DEMAT accounts has been around 33% CAGR basis. And yet in India's population, only 13%. As of FY25, only 13% people have DEMAT account. So still more than 80% people do not yet have DEMAT account. Imagine when out of these 80%, let's say even 50% people open DEMAT account. The growth is huge in this particular segment for the next 15 to 20 years. Now, the third reason is the growth of SIPs. So have a look at my screen and you will see that since FY16-17, the growth rate of SIP contribution in Indian stock market has been around 26%. This is a huge growth that we have seen in SIPs, especially in FY25 and 26. Even though the SIP growth rate has been excellent, if we compare the AUM to GDP ratio in India versus advanced countries like US, we are still at only around 20%, and in US this ratio is at around 124%. So there is still a lot of growth from a mutual fund SIP's perspective. Now I can continue to show you more data points, but the point is very, very simple that capital market theme for the next 20 years is likely to be a very strong tailwinded sector. Of course, there will be some cyclicity built in it. Whenever the transactions drop on exchange, there might be huge correction, and those are the opportunities for people who want to sit and buy those opportunities that are for long term. As an investor, I am absolutely bullish from a long-term perspective. And if you have not yet explored this particular segment, I highly recommend that you go and explore this particular segment. Where do we start? So there are 2 ways. Number one is that you can go and invest in index mutual funds which are on capital market theme, so that you're not doing stock picking. You are just relying on that index. I'll speak about that in a minute. And the second approach is that you go and learn about individual stocks. So in this video, I'll speak about 3 stocks as well, so that you get a good insight and well-rounded views in terms of your options. None of these are recommendations, but I hope you're going to get a lot of insights from this video. This might be slightly longer video, but guess what? This type of theme does need a lot of my time. Hope you like this video, and if you're new to the channel, please hit the subscribe button because your subscription motivates me and my team to do a lot of research for you at zero cost. With that, let me start with first option, which is index fund. So there is an index called Nifty Capital Market Index, and if you look at the allocation in this particular index, you will see that exchange and data platform sort of stocks takes around 40% contribution as of now. And if you look at asset management companies like your mutual fund houses, around 23%, stock broking around 19.5%, depository, clearing house, etc. 13.5%, and then there are financial product distributors making it to 100%. If I talk about large cap, mid cap, small cap, then primarily it is mid cap driven 54%, small cap 29%, and large cap 15.9%. What does this mean? That this index is likely to be very, very volatile, okay? Because high contribution of mid cap and small caps. So these are not for conservative investors. If I look at the top 10 stocks as of now by weight, then BSE 19.8%, MCX 17%, HDFC AMC 13%, and you can see all these allocations as of now, right? If I talk about the past performance, which is not guaranteeing the future performance, if we look at 1 year performance, 3 year performance, 5 year performance since 2019 when this index was created or benchmarked against, you will see that returns versus Nifty 500. So 25.4% in last 1 year, 58% in last 3 years, 31.9% 5 year, 24.6% since 2019. These are annual returns, and the data is as of 30th March 2026 when the stock market saw a huge correction because of the war situation. If I quickly speak about the SIP performance, not a great performance in last 1 year, okay, but 3 year and 5 year basis, very good performance. Again, these are not guaranteed performance for the future, but in the last 3 to 5 years, this segment has been really doing exceptionally well. And in my view, it is likely to do well if you're a long time investor for 5 years, 7 years, 10 years. So if you do not understand how to go about picking these stocks, understanding the nuances, then in that case, you can go and explore capital market index. Okay. But now let me speak about the direct stocks as well. I'll give you commentary about one of the exchanges. I will give you a commentary about one of the brokers, and I will also give you a commentary about one of the AMCs, so that you get a very rounded view in terms of what sort of growth we are getting in these 3 segments, so that you get a very holistic picture. With that, let me go to stock number 1. Stock number 1 is BSE, Bombay Stock Exchange Limited. I'm going to talk about 2 very critical points about BSE Limited that you are not going to find anywhere else. Please pay attention for the next 3 to 4 minutes. Okay. First point, if you see these financial numbers for BSE, very interesting pattern you will see since COVID FY20. If we see top line growth around 34% CAGR basis, net profit growth at around 60% CAGR, and this is very consistent year on year. Okay, you see the graphs here. Blue line is the revenue line and the orange is the profit. Okay, now if you see the net profit margin in FY20 used to be around 14%, it's gone to around 48% in FY26, which is around 3.4 times growth. Okay, now the question is, why such a growth in the net profit? So please understand one thing: more and more transactions come on BSE platform, then their margins are likely to improve. Why? Because the fixed cost is a fixed cost and their main money is being made from transactions. Let me show you that data point and then we'll talk about the valuations, extremely critical point. So first let me talk about their transaction volume. So 73% of the top line comes from transaction charges. This is their main business. Okay, there are other businesses, I'm not going to go into details of it. Point you need to understand is that if in the Indian stock market transactions continue to grow, their business is likely to grow because 73% of their top line is coming from transaction charges. Now if I were to give you the breakdown of transaction charges as well, very important point, right? Equity cash versus F&O. So equity cash is only contributing around 5% of their total revenue. So that is not where their main business is. Their main business is coming from F&O, which is equity derivatives. Around 60% of their top line is coming from derivatives, futures and options. This is where the money is lying. Now a lot of hoo-ha happened around STT charges being impacted from 1st of April, etc. Now the management clear cut said that option STTs, there is not likely to be any impact. Okay, futures, they said that we need to be watchful about it. And here is the latest data for you. In the month of April, 1st of April, the STT increase was impacted, right? Now, if you look at the volume, what happened to the volume? In fact, in BSE, the volume was higher as compared to NSE. Even though the STT has been increased, the F&O volume have gone up. The market share of BSE temporarily have gone higher than NSE. Of course, there are some nuances around, whether this is due to the volume or the pricing, etc. But the main point you need to understand is that although the STT increase has taken effect from 1st of April, BSE has not lost the market share. In fact, the market share has gone up. And also, if you look at the strategic cost advantage that BSE has, BSE's charges are much lower than NSE. So this is where we stand in terms of the transaction volume, charges, and the growth that we have seen in BSE. More importantly, if we talk about management's vision, they're likely to introduce at some point in time commodity trading as well. Also stock options as well, which are ESOPs, etc. So a lot of room to grow for the transactions. And you know what? Anyways, the DEMAT account penetration, the overall contribution from Indian population to transactions is likely to grow if you look at long term. If you think 2040, then the transactions that we're seeing right now, they are likely to grow multifold. I don't know how much, I don't have any estimation, but the company is going to go and enjoy that sort of premium because of these volumes. Now comes the second critical point about BSE, which is the valuation. So if you look at the last 3 years PE ratio, because maximum growth has come in last 3 years, so we have to look at PE ratio from last 3 years perspective. It is trading right now at around, let's say, 63. Now the median PE has been around 69. In my view, very good place to be is at around 50 P. So somewhere here, 50 P, 52 P, these are very, very good levels given the growth prospect of BSE for the long term perspective. Why do I say 50 P is very, very important PE ratio? Because if you look at NSE, that is where the main competition is coming from, which is in the unlisted space right now. Okay, it's not yet listed. Listing timelines are on your screen. There is a chance that it might get listed by Q3. Okay, we don't know exact timelines, they might vary, but NSE will get listed at some point in time. And if you look at the current valuations of NSE in the unlisted market, it trades at around 40 P. The moment NSE lists, there might be some temporary setback for BSE because there will be two exchanges competing for the investors' attention. But as of now, if you ask me, the PE ratio is slightly on the higher side, 63. I don't know when you're watching this video, but to me at around 50 P, BSE will make a lot of sense given the growth prospect of this particular company. This is what my analysis is on BSE. Very, very good company, growing company. And time to time when SEBI will intervene in terms of the volume or the prices or changes in FNO, you will see pressure on this particular company. Those will be the opportunities in my view. That's the stock number one, which is BSE. Now let me go to the second company, which is on the broking side of the business. But before that, so far if you're liking this video, request you to hit the like button, subscribe to my channel because your subscriptions will motivate me to continue to bring solid content for you at zero cost. Also, if you want to learn practically, you can join my exclusive community on YouTube, where almost on daily basis I'm sharing insights like these so that you become an informed and educated investor about stock market investing. Feedback of this community has been excellent. Simply go to my channel, hit the subscribe button, and then find the join button and be my guest. With that, let's go to stock number 2 now. The name of the stock is Groww, which got listed in November 2025. The premium was at around 14%. The listing price was at around 114 on BSE and 112 on NSE, right? Now, if I talk about this company's valuation at the time of IPO, back in just November 2025, PE ratio was at around 40 and the price to book was around 11.76. Right now, if you look at the same ratios here, PE ratio is at around 62. Okay, and the price to book is at around 13.5. So why all of a sudden after the listing, the price to earning ratio has shot up from almost 40 to 60, 50% high? Okay, couple of reasons for that. First of all, if we look at the Q4 results that just came out, total income of the company has gone up by around 81% YOY basis. If you look at the EBITDA has gone up by around 142% year on year basis. If you look at the PAT has gone up by around 122% year on year basis. These are some huge numbers, okay, on YOY basis. Right now, if I look at the customers, number of transacting users, they have gone up by around 25%. Huge numbers, huge growth rate we have seen in Groww. Okay. Also, if I talk about the operating leverage, cost to serve, cost to grow, cost to operate, all these parameters, their cost have come down and therefore their EBITDA margins have grown from 50% to almost 66%. It's the same theory that I explained to you in the BSE analysis. They've built their all the pipes and their everything that they need to be as a fixed cost. Now more transactions pour into this channel or platform. What is likely to happen? Their cost to serve will continuously come down and their operating margin, their EBITDA margin, everything is likely to continue to remain high. And very similar to BSE, if I look at the business segments of Groww, you will find that 57%, almost 55 to 57% of their top line is coming from where? FNO. This is where the money is being made by Groww as well. You can see clearly 55% of their Q4 FY26 revenues came from FNO segment. Now Groww is doing a lot of things within their company. Okay, for example, very recently they launched commodities. They launched primary bonds. They are getting into secondary bonds. They have acquired a wealth management company called Fisdom, right? They're getting into that big time. They launched their mutual fund business as well, AMCs. That is also growing. The AUM of that business has grown at around 2.5 times in 1 year. So a lot of things this company is doing potentially from a growth perspective. Again comes the valuations. PE ratio very high right now at 60. You have to wait for the PE ratio to come down. In my view, it may never come down, but the valuations are very high right now. In my view, if a company is giving you PAT growth of more than 100%, then of course 50 PE is decent, because if they continue to give you 100% PAT, Even if it comes down to, let's say, 80%, 70%, 60%, still 50 P is not a bad P in my view. That's what I would say about Groww as a company. Fast growing company, okay, and overall I think they are making a good impact on the broking industry as such, and they are getting diversified into the wealth management, etc. Again, not a recommendation here, but I've given you these insights which are totally data backed. I've given you my concern around the valuations as well. You do what you need to do. Again, I can't tell you buy or sell, either ways, right? But if you like this analysis, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to continue to do more research for you at zero cost. With that, let's go to stock number 3 and rather look at the segment which is AMCs, mutual fund industry. Now, when it comes to mutual fund houses, have a look at my screen. What do you see? From a leadership perspective, SBI is number 1. They are not yet listed. They are likely to get listed in 2026, followed by ICICI and HDFC. ICICI has around 13.5% of the market share, followed by HDFC at around 12.5%. So since SBI is not yet listed when I am creating this video, let me do a quick comparison between ICICI and HDFC. These are the two leader companies which are listed on the stock market. So ICICI, if you look at the FY26 growth rate, top line grew by around 20%. Okay, and the total income, which is the PAT, that grew by around 24.5%. In contrast, if I look at HDFC, their growth rate at top line has been around 14%, while their PAT has grown at around 16%. So clearly, ICICI has grown at a faster rate than HDFC. Okay, and ICICI is at number 2, so their market share is also high, their AUM is also high, meaning that at a higher base, ICICI is able to grow faster than HDFC as of now in FY26. If I talk about the operating margin of both these companies, very similar profile, around 37 basis point for ICICI, and if I look at HDFC, it is also at around 35. Minor difference, but overall, it's a very similar operating profit margin sort of a profile. If I talk about return on equity, for ICICI, it's very high, at around 85%. Okay, while if I look at HDFC, it is at around 32.9%. So clearly, from all parameters perspective, ICICI is better company from a quality perspective as of now, looking at the past track record. If I talk about the SIP transaction, so here is the data for HDFC, and what you would note is that all the AMCs will show you very similar pattern here, that SIPs in the last 3 years, 24, 25, 26 has grown at a very healthy growth rate. Now, can this growth rate sustain? The answer is yes. It is entirely possible that more and more people will open their DEMAT account. They will start doing SIPs because a lot of content has been created around it and people want to invest for long term. They no longer want to just be invested in FDs or gold. They want to diversify. So overall, if you ask me, 2040, all the AMCs are likely to see good contribution in their SIPs. But then comes the valuation versus growth rate. So here is the data for you, ICICI, HDFC, if you compare their PE ratios. As of now, at around 48 and 42. So ICICI is trading at premium. Naturally, why? Because I talked about the quality of the company, better than HDFC as of now, right? But the question you need to ask yourself is that the growth rate in ICICI was at around 24% from a profit perspective, but the PE here is at 48. Right? What will it do to the PEG ratio? It will make the PEG ratio go higher than 1, right? So in my view, I am not very keen on AMC businesses. Why? Mainly because the growth rate is there at around 24-25%, but the PE ratio is also very high, and it's not giving me that comfort versus the broking business that we saw. For example, Groww business, we saw the exchange business, which was BSC. That's where I think growth is very high and the PE ratio is higher, but you have to look at the PEG ratio here if you want to compare the segments. And whenever there is a bad news for AMC businesses and if their stock prices fall, like during the war situation, many of these AMCs fell by around 20%, right? 25%. So go have a look at that data, and when the PE ratio is calmed down, maybe that is the point of time where you like to look at the growth versus PE ratio. But as of now, it looks very high to me. I've given you the comparison of the top 2 AMC businesses as of now, right? SBI will get listed in the month of, let's say, September, October 2026. I don't know when exactly. But when SBI get listed, it becomes very interesting to look at all the 3, which is ICICI, HDFC and SBI, and look at the holistic picture at that time. This is the thought that I'm going to leave you with. Again, I'm not going to give you anyways buy or sell recommendation here, but hope this high level analysis tells you something about capital market theme. I haven't really covered the wealth management sector here, okay? I'll have to do another video for that. Companies like Nuvama, Motilal Oswal. I mean, there are a lot of other companies as well in this segment. And if you're not sure about individual stocks, explore capital market index as a theme, right? That's all I can say. There will be corrections in the next 20 years, of course, that is likely to be the case, but as a long-term theme, I think this theme is likely to do well along with other themes like data center, semiconductor, etc. I hope you enjoyed this video. If you did, press the like button, let me know in the comments a simple thank you, and don't forget to subscribe to my YouTube community. There is a lot of value that you will get out of that community. With that, I'm going to see you in the next video. Until then, keep rocking.